So here's where we're at. It looks as though the S&P has a date with the 200-day moving average, which is at 43.26. What you look at where money is actually flowing right now, let's review that. In terms of M&A, the month of August, already 12 days in, is the best month for M&A transaction that the market has had since November. Growth funds have seen in the past week their largest inflow since December. We saw equity funds with their largest inflow over the last 8 weeks. Taxable fixed income has reversed 18 straight weeks of outflows with 2 consecutive weeks of inflows. So that's where the money has been flowing recently. Now let's look forward and see where the money could be going. What's interesting is I mentioned the 200-day moving average. There are a tremendous amount of rules-based, non-emotional, non-discretionary funds that follow the critical moving averages. And if we are to elevate above there, you're going to see them have to be buyers. They're not going to worry about what inflation is going to look like or what the Federal Reserve might do. In addition to that, those that follow momentum on both a 6 and a 12-month time frame, as you roll into September, Frank, if you've got the S&P pricing somewhere around 43, 4,400, you're going to have a couple of $100 billion worth of fund buying that's going to come from those strategies. Again, it's all rules-based. So the quants, as we look forward into the fall, they could be the sponsorship for further buying.
All right, Brent, I want to come over to you. Joe's kind of hitting on where the money's going. Speaking of where it's going, according to B of A, largest inflow into tech in 8 weeks last week. Also, 5 straight weeks of outflows from TIPS, Treasury inflation-protected securities, largest streak since April of 2020. When you hear those numbers, what does that say to you?
Well, it says to me, we're in this environment where, we finally got great news, in my view, with CPI numbers finally starting to come down a little bit. So many indicators previously had pointed to that, but we just weren't seeing it show up in the actual data. So it's here. So that makes sense that investors are then, assuming we're at peak inflation, starting to rotate out of some of that TIPS exposure. But I think when we think about technology, somebody asked me recently, how do you position a portfolio for a low economic growth environment? And I said, the best place to look is probably what happened during the last economic cycle when technology was really the place to be. That's typically where investors gravitate towards companies that can grow even if the economy isn't growing very much. So I think that explains a lot of the technology flows that we've seen. But when we look at technology as a whole, we have Apple and Microsoft, for example, that are really starting to hit the upper bounds of valuation. So I don't think the group as a whole is likely to drive the market materially higher from here. But I think we need broader participation. But to Joe's point, if we do see money flowing into the S&P 500, Apple and Microsoft are a pretty significant piece of that. So they will potentially just move upwards, even in the face of higher valuation.
Yeah.
So I think we could have some powerful moves if people really do start deploying cash back into the market.
Yeah, absolutely. We're seeing a good day for big tech today.